I'll just teach you a bit of mathematics, which is really incredibly important. It's very simple. If you take a coin, and it's 50-50, obviously, and you flip it 10 times, and it came up heads every time, does that mean it's a winning coin? Okay. If you flip it an infinite number of times, 50% heads, 50% tails. So what we're running with those simulations is to see what's the worst case and the best case that could happen. Obviously, the best case is all heads, but it's hardly ever going to happen. And the worst case is all tails, but it's equally hardly ever going to happen. So what we're doing with portfolios and the volatility of their historic price movements, which takes the assumption that those historic price movements would repeat themselves, okay, and most stock prices move along what's called a log normal distribution curve, but the size of that curve depends upon the volatility of the security. So Tesla's is quite wide because it's got a wide range, whereas Microsoft's is relatively narrow by comparison, whereas Nvidia's is both wide and really high than Microsoft. Okay, so the point is, if within those ranges, those coin flips, what could happen in a worst case? Best case, we don't care, because the best case always looks too good. It looks great. It looks fantastic. Everybody's rich. But the worst case, and then when you run those, and that's still no guarantee of the future, because tomorrow there could be a nuclear bomb, we all die. There's no guarantee of the future. When we run those, we then get a better idea of, okay, how do they correlate with each other in a down market? Not, oh, they're in different sectors, different geographies. That must be diversified bullshit. Okay.